Okay. Hello, and thank you for joining me. Welcome to the Health Advantage Credit Union HELOC 101 webinar. My name is Brianna, and I am the Financial Services Manager here at Health Advantage. I have the pleasure of going over the finer points of home equities with you. So first off, I kind of wanted to go over a brief overview of the following terms to maybe kind of give you a better understanding before I get into the main subject. So annual percentage rate is the cost of credit expressed as a yearly rate. This is abbreviated as APR on many documents that you might see. The credit limit is the maximum amount that may be borrowed on a credit card or under a home equity line of credit plan. Closing costs are fees you pay when you close or settle on a loan. These fees may include application fee, title examination, title insurance, recording fees, appraisal fees, etc. Equity is the difference between fair market value of the home and the outstanding balance of your mortgage, plus any outstanding home equity loans. HELOC stands for Home Equity Line of Credit and is a loan where your home serves as collateral. Home equity line of credit is a line of credit secured by the available equity in your home. You can continue to borrow against it as little or as much as you need throughout the draw period. That's generally 5 years. Up to the approved HELOC limit established at your closing. Once the draw period has ended, you enter the repayment period. An interest rate is the percentage rate used to determine the cost of borrowing money. Usually this is stated as an annual rate. Minimum payment is the lowest amount that you may pay, generally monthly, in the agreement. Sometimes this covers only interest, and sometimes it covers both principal and interest. A variable rate loan is an interest rate that changes in regards to the index, like a HELOC does, as with the prime rate. The payments then increase or decrease accordingly. Variable interest rates can change as soon as month to month or annually on April 1st each year. The rate is calculated based on an index and margin, generally the U.S. prime rate. Loan to value ratio is a number Health Advantage uses to determine how much we can lend on a HELOC. It measures the relationship between the loan amount and the market value of the house. If you already have a mortgage on the house and are looking for a HELOC, we would use the combined loan to value, which is the ratio of the total of both loans and then the value. SEV is state equalized value of the house. This is adjusted following state and county equalization, or the taxable value. Now that you have a little knowledge of some of those terms, what is a HELOC? I filled you in on the last slide that HELOC stands for Home Equity Line of Credit. It is a revolving line of credit that is secured by the available equity in your home, and the home is used as collateral. In many cases, a person's home is their most valuable possession. So a homeowner may use the value left in their home for major wallet-hitting items such as education, big home upgrades, sometimes medical bills. The loan amount is determined by the value of the property minus the balance owed on your current mortgage. Lenders usually set a credit limit on a home equity line by taking a percentage of the home's appraised value and subtracting the balance owed on its existing mortgage. To make it easy, let's say your home appraises for $100,000 and your lender will allow you to take up to 80% of the value of the home out on a home equity line of credit. So the highest amount total would be $80,000. So if you owe $50,000 on your existing mortgage, you could potentially borrow up to $30,000. As you repay on your outstanding balance, the amount of available credit is replenished, much like a credit card, until the draw period ends. Also, because this is a line of credit, you can make payments in interest on the amount of your balance that you have borrowed, not on the full amount available. So you're only making payments on what you borrowed. What is a home equity loan? A home equity loan is similar to a home equity line of credit in regard to borrowing up to a certain percentage of the value, whether it be 80% or 100%. However, it is different than a line of credit in being that it is a one-time advance. You would receive the full amount at your closing, and this loan is paid in equal monthly payments over a fixed term, much like an original mortgage, and no extra draws can be done. So your monthly payments will stay the same, paying that loan down. So weighing out the home equity line of credit and the home equity loan, benefits of a home equity line of credit is that you borrow as you need. You only pay interest on what you have advanced, then the rest can be available for emergencies. The con could be rising interest rates would make minimum payments fluctuate or increase at any given time if it is a variable rate home equity. Benefits of a home equity loan, the rate may be lower. It is a one-time draw. The fixed rate will keep the payment the same during the whole term. A con would be if you were to tap out all of the equity in your home in one home equity loan, this could work against you if property values start to decline in your area. Okay, so fixed rates and variable rates. A variable rate interest rates can change as soon as month to month or annually on April 1st. The rate is calculated based on an index and margin, usually the U.S. prime rate. Your payment may change as the interest rate adjusts. Health Advantage variable rate HELOC loans are a 15-year loan with a 5-year draw plan on the loan and 10 years of repayment. And you could potentially borrow up to 80% of the value of your primary home. I went too fast. Going back. The fixed rate, with the fixed interest rate, the rate is determined at closing, and your rate will stay the same for the entirety of the term of the loan. This generally protects you from rising interest rates. Our HELOC fixed rate loans are a 10-year loan with a 5-year draw plan and 5 years repayment. And you can borrow up to 80% of the value of your primary home. So what can a home equity line of credit be used for? Well, it can be used for, has many purposes. Whatever it benefits you, anything from new home improvements, repairs, debt consolidation, financial emergencies, new purchases. I even had a loan one time done because the couple's 4 children were all getting married in one calendar year. So they knew that they needed extra money. Okay, so how much can you borrow? Well, depending on credit worthiness and the amount of your outstanding debt, you may be able to borrow 80% or more of the value of your home. There are times when an SEV can be used instead of an appraisal to see how much you can borrow. The SEV is the state equalized value. This value is updated annually by your local assessor. Some questions to ask when looking for a home equity rate or when looking for a home equity are, is there a minimum withdrawal requirement? How can you access the funds? Once the draw period ends, can you renew the credit line? In addition, notable questions to ask regarding the home equity loan are there any annual APR financing charges or fees? To access the funds of a Health Advantage HELOC, you just need to call in and request the draw. The funds are then deposited into your account within minutes. What should you look for when you're shopping for a home equity line of credit? Well, first, always look for a plan that best fits your needs. In addition to asking about rates and monthly payments, inquire about annual fees, closing costs, and costs of establishing the plan. Another question to ask is how long does it take to be able to get the funds from a home equity line of credit? At Health Advantage, a home equity line of credit can be done in as little as 2 weeks, depending if an appraisal is needed. If the monthly payment concerns you the most, you may want to inquire about the 15-year variable rate loan, as you have a longer time to repay and generally a lower payment. If you are concerned about rates more than payments, you may want to inquire about the 10-year fixed rate loan, as your interest rate will stay the same throughout the repayment process. Okay, so upfront and continuing costs. When you take out a home equity line of credit, you pay for many of the same services as you do when you originally financed your mortgage. These expenses can add significantly to the cost of your loan. These may include, again, application fee, title search, and points, which is the percentage of the amount that you are borrowing. The continuing costs, such as an annual fee or participation fee or transaction fee, will add up over the years of the loan as well. There are no annual fees on a home equity line of credit with Health Advantage, and the closing cost is only $99. All right, 3-day cancellation rule. Federal law gives you 3 days to reconsider your loan after a signed credit agreement for either a home equity loan or home equity line of credit without penalty. Under the right to cancel, you have until midnight of the 3rd business day to cancel the credit transaction. During the waiting period, there can be no activity related to the contract done in your account. Therefore, no money distributed. So if you were to sign documentation with a Health Advantage representative on a Wednesday, you would need to wait Thursday, Friday, Saturday. We're closed Sunday, so the funds would be deposited and distributed to your account on Monday. Okay, so harmful home equity practices. Loan flipping is the lender encourages you to repeatedly refinance and borrow more money. Doing this, you may pay the same fees and interest points over and over each time on a new loan when a new loan is done, which is continually increasing your debt and continually paying fees. Insurance packing is when a lender unnecessarily adds insurance to the loan, like adding credit insurance without going over it with you or giving you information on it to make an educated decision on if you even need it. Bait and switch is where the lender offers you one set of terms, then pressure you to accept higher charges at signing, just to complete the transaction. And the home improvement loan is where a contractor reaches out to you, offering you services and says they'll arrange financing. Oh, the home equity improvement loan. We have all heard of the contractor that comes to offer services, has you pay, then you never see him again. This is a similar situation, but in this scenario, the contractor tells you he will find you a financing company that he knows and is extremely reasonable. He starts the work, then has a packet full of papers you have to sign after he has already started. These papers may be blank, or the contractor rushes you through them, not answering questions, and threatens to leave if you don't sign the paperwork right now. Once you do sign, the contractor then rushes through the work, leaves you with a high interest rate and lots of fees, as well as home repair that is less than acceptable, with no interest in coming back to complete the job correctly. If you ever have any questions on any of these, contact your credit union. And the home equity line of credit benefits with Health Advantage. We have many benefits with our home equity line of credit program. Both the fixed and variable closing rate is $99. That's it, just $99. And we're currently running a promotion waiving that cost. So 0 closing fees, and potentially you could have your funds in as little as 2 weeks, as I said, depending on if an appraisal is needed. Currently, our variable rate for the home equity line of credit is as low as 4.5%. On our fixed rate, it's 5.75% for the length of the term. Both products are a line of credit, so you can continue to use the funds available and only pay on what you use. That's what I have for home equity line of credit information. If you have any questions, please feel free to give us a phone call, and we would be happy to answer you, whether it be myself or one of the financial services reps here at Health Advantage. All you have to do is call in or go online, schedule an appointment, and we'd send you a list of documentation that you'd have to round up, much like a mortgage, to bring in, and we start the application process right then and there. Thank you again for joining me. Have a great day.